If you want to become better at trading options on Robinhood, here are 5 strategies that you can amplify to trade the market like a pro. The first strategy is called a long call. Now this is a bullish move. Now the way you buy a long call is basically getting a call with around 6 months of time. This is because the time value is going to play a huge role in the premium. You want to buy an option contract that has a high delta, because that way every time you make money with that option contract, you're going to make more money depending on how high the delta is. And always remember that the best time to buy a long call is usually when stocks are at their all-time low, because most likely they will go up with time, and you benefiting off of that cheap premium that you get when the stock is at all-time low, it's going to give you the benefit of more profits when the stock does go up. And not only that, but you will be able to profit by using a technique called calendar spreads, or selling covered calls, which I'm going to talk about in the next strategy. And if any of this doesn't make sense, make sure to check out my How to Trade Options on Robinhood, where I go over the Greeks, what is the delta, what is the theta, what is the vega, everything you really need to understand options. And this brings me to the next one, which is covered calls. Now this is when an investor holds a long position, such as a stock, and basically sells call options at the same asset with different expiration date to make monthly income. Now this is a kind of complicated process, but basically what you do is a covered call, you own 100 shares of a stock, and you basically leverage those 100 shares every week by selling a call. And you sell a call. The only way to sell a call is by having those 100 shares as leverage. And basically, when you sell a call every week, you're given credit. So you see $15, you're going to be given $15 every week just for selling your call. Now, selling a call has 2 outcomes. You either sell a call and the stock price does not go above the strike price of the option contract that you sold. In that case, you keep the credit that was given to you, and you can sell a call again next week. The second outcome is that the stock price goes above the call that you sold, resulting in you having to be forced to sell the 100 shares that you already have, but you get to keep the credit that was given to you for selling the call. I know it's a bit complicated, but there is a strategy in which you don't necessarily need to own 100 shares. You can just buy a call contract, a long call contract, like the one I talked about in the beginning, and that way you could actually leverage that call contract to get weekly income by leveraging that call contract. But that is not called a covered call. That is called something else. That is called a calendar spread, which I'll go over in another video. So make sure you subscribe to the channel. I highly recommend this strategy for anyone who wants to make money passive income basically. And it's a great strategy for just holding shares. So it's pretty safe, whereas you just hold a bunch of shares from a company and you sell covered calls every single week by just holding your shares. And the more shares you have, the more calls you could sell, and therefore the more money you could be making every week. I have been doing this strategy for over a year now, and I've been receiving $500 up to $200 every single week just by doing this technique. And guess what? With that money I'm receiving just for holding my shares, I can play around and learn different types of option strategies with that income, and I don't even have to work. All I got to do is know how to sell calls. It is a bit risky, but in the sense that you don't really lose anything besides the potential gains you could be getting by selling your call early. And if you guys want more information on how to use this strategy, I'll have more videos on my channel below, so subscribe. Okay, so the next strategy is called a call debit spread, which is bullish. This is basically when an investor buys and sells options at the same time with different strike prices in a way to minimize how much the cost can be and minimize the potential loss. Now, debit spreads are great if you're trying to play it safe. So it's basically when you buy a call in the money, and then you sell a call pretty much out of the money. Now, once you know how to sell a call and buy a call, this is pretty simple. But basically what you're saying is that you're gonna own the stock at $5, and your max potential profit is gonna be once the stock goes above 6.5. Okay, now as you can see, it's going to be a lot cheaper than just buying a call. This is a good way to buy into a position without wasting too much money, without leveraging too much money. As you can see, it says max cost is $72, but if I buy one, it's only $46. The reason why is because of the spread. You can actually change how much the price will be depending on how much you put in, is how quickly the order is going to fulfill. And I'll talk a little bit more about that right now. But as you can see, the loss and profits chart, you can only lose $46. You can only lose what you put in, but you can win much more than you put in, which is awesome. And I love this strategy. If you want to learn how to trade options, learn this strategy because it's going to minimize your loss and it's going to maximize your profits. Okay, so when it comes to credit spreads, you can have a put credit spread and you can have a call credit spread. Basically, the idea behind credit spreads is that often you get money for making the play. So this is a great way to actually make plays without necessarily having the capital to do so. To do a credit spread, you need to buy a call and sell a call right below the call that you bought. As you can see right here, I'm choosing to buy a call and sell a call. Now, when you're buying a call and selling a call, you're basically betting that the stock's going to go down or move sideways. And when you're playing with puts, you're basically betting that the call's going to go, that the option is going to go up. I know it's a bit confusing. It's a reversed. So when you're buying a put credit spread, you're hoping that the stock goes up. But when you're buying a call credit spread, you're betting that the stock's going to go down. As you can see by the P&L chart, I'm actually gaining money if the stock goes down, but I'll lose more money if the stock goes up. So this is a great way to bet against the market or with the market without spending so much money. And if you already have a lot of money in your account, this is a great way to play options by playing it safe and not necessarily risking too much money. Okay, so for the last one, we're going to be talking about Strangles. Now, Strangles is a good strategy to learn. This strategy, it's my favorite. And this is basically when you buy a call and a put on the same stock with the same expiration date. Now, the benefit of this is that you will profit if the stock moves at whatever direction. However, you're going to lose money if the stock doesn't move. So it's important to use this strategy on stocks that move a lot, such as Tesla. In this example, I'm using Intel, but I wouldn't recommend trading this with Intel. But it is a cheap option to play if you are playing with a stock that is a lot cheaper. However, if you have the money for it, play it on Tesla, play it on SPY, play it on equities, stocks, ETFs that move a lot. Okay, so we're looking at the P&L chart here, and as you can see, we actually gain money if the stock goes up or down, but it has to go up by a good amount of a good margin amount, because if it doesn't, then you're just basically losing money. Now, the one thing I hear a lot of new traders confused about is, well, if it goes up, then aren't I losing money from the put? Well, yes. So basically what you have to do is, if you notice that the stock is going up and a bullish pattern, then you have to just cut your losses with your puts and just hope that the call actually takes a good portion of gains and that it doesn't reverse. Now, this is a strategy that's pretty difficult to learn and master, but once you learn it, you literally are always going to make money. And just like that, those are 5 strategies that you could learn to better your game in option trading in Robinhood. So if you want to learn more about each individual strategy, subscribe to the channel where I'll be uploading in-depth description of how to use each strategy in a lengthy video.